The Bank of Canada just made a pause on the overnight rate, leaving us at 2.75% today. Now, on the outside, this might seem like not a very big deal, but the BOC's decision to not do anything at all was actually a very impactful decision, and it was very loud. So let's dig into why they paused, what this means for the economy, where things could go, and how the tariffs are going to affect you if you have a mortgage and you're thinking about what to do next. All right, let's start off with the core reason. It's uncertainty. The BOC laid out two potential outcomes of what could actually happen after today's actual hold decision and what that could mean for you. But if you think about it from this context, they decided to err on the side of caution about what potentially could happen with the tariffs, as opposed to looking at what's actually happening right now in the economy. So here are the two potential scenarios. So scenario number one is that with the tariffs, growth weakens temporarily, and inflation stays near the 2% target, which would mean the BOC made the right decision to hold interest rates today. Scenario number two is an all-out trade war. Whether it's directly with Canada or with Canada and China, everything goes out of control, and we see inflation spike back up to 3% or higher. And I quote from the BOC, Tiff Mackham, "We still do not know what tariffs will be imposed, whether they will be reduced or escalated, or how long all this will last." That level of policy fog is what caused the rate to hold today. And it's not just a Canada problem, this is actually a global issue. So what this means globally speaking is the following. Now, global growth itself was solid for the end of 2024, but now the US economy is actually slowing and consumer sentiment is actually falling. Inflation expectations are actually rising right now, which means Canadians are expecting more now than ever that things are going to go up in price. That's not good. On top of that, businesses are stopping hiring, which we saw a reduction in the amount of full-time jobs, and then unemployment actually went up. Plus, businesses are investing less and less money in our overall economy. Now, what's interesting is that China showed very strong Q4 numbers, but in Europe, it's very weak, especially in manufacturing. Now, what does that mean to you from a financial markets perspective? Well, the stock markets are crazy, up, down, left, right, and center. The US dollar is down, which actually, believe it or not, is not a good thing for the overall economy, with the dollar dropping from 110 in January to below 100 this week, and that's on the DXY exchange. Oil prices, as you know, have dropped sharply, and yields, which is the Canadian bond yields, had fallen down, but have reversed course and started to come back up again. Everything is a little bit out of control. Here's what it means to you as a Canadian mortgage holder. On the inflation front, back in February, we saw the GST holiday go away, which immediately brought inflation back up just a bit. But then in April, we saw the reduction or elimination of the carbon tax, which brought down fuel prices, which is reducing energy costs. So it's kind of balancing itself out to a degree. And I think the BOC is waiting until the next report next month before they make a lot of decisions on where inflation lands, particularly in light of this tariff situation. Again, let's talk about what this means for you as a mortgage holder, because that's the most important thing. Variable rate mortgages, first and foremost, no change today. You're seeing most uninsured variable rate mortgages around prime minus 50 right now on a 30-year amortized loan. It's a little bit higher and a little bit lower depending on your situation, but ultimately that puts you around a 4.4 or 4.45% range, with a little bit less and a little bit more depending on the banks. Many of the lenders have started to take away their discounts. A discount on prime is like prime minus 0.5, prime minus 0.6, prime minus 0.7. Now, a couple of months ago, we were seeing rates of prime minus 7, prime minus 8, prime minus 1, or even lower discounts, and the banks have started to increase those discounts recently. So if you believe that variable rates are the way to go because you're looking at the future of the economy, then you should definitely lock in a variable rate today. In the fixed rate market, the bond yields remain exceptionally volatile, and it is the spring market. So we're seeing a lot of the lenders compete, but they're only competing so much. And over the course of literally 5 business days, we saw the yields go down and up by 0.25%, which has caused a lot of the lenders, banks included, to increase interest rates dramatically. Plus, as we know, some banks will negotiate discounts after funding, and they're no longer providing the same level of discounts that they were just a week to 2 weeks ago. Whether or not that sticks around really depends on the volatility of the marketplace right now. But it looks like we found some form of an artificial bottom. I wouldn't jump too far into that prediction right now, just given everything that's going on in the marketplace. Fixed rates themselves could be relatively attractive today, but it's important to keep in mind that with the tariff situation, things could rebound quickly and we could see fixed rates start to go up. This is one of the reasons that if you have a renewal 6 to 8 to 12 months from today, it might be worth the idea of getting an approval with us today, locking down a fixed rate and assessing the next 2 to 3 months to see what happens. It could actually work out in your favor, particularly if you could lock in an interest rate today at a lower cost and refinance early. Even with that potential interest penalty, that could actually save you money. But what is actually happening in the real estate market? Well, this is really interesting because in March, real estate actually really took off in many places of the country. Now, there are obviously obviously some outliers like Toronto condos and some other pre-sale properties, but detached homes overall in the country were up significantly over the course of the last couple of months. Now, come April, as soon as the tariff situation got bad and of course the election started ramping up, we stopped seeing as many transactions, and we've seen the amount of listings go up dramatically as people are trying to move in the spring, and the amount of buys go down. What this could lead to is a fantastic buyer's market right now, with interest rates looking to be eclipsing near the bottom, and with a high amount of listings as people wait to see what happens with the tariffs and wait to see what happens in the election. That means that Canadians are frozen, and there could be some buy opportunities for a smart investor or a smart buyer. One word of caution for anybody buying in this potential market with the volatility of the last couple of years: whatever you're buying, be prepared to hold on to it for at least 5 to 7 years. That's my personal advice anyways, but objectively speaking, in this type of market, because it could go up or it could go sideways, if you're looking to build equity, there's a lot of choice right now, but make sure you can hold on. So here's what I want you to take away from this. This isn't a pause because things are stable right now. It's actually the exact opposite. This is a pause because the market is completely unstable and unhinged. By not making any decision at all, the BOC has made the most massive decision to not do anything and let the market dictate what actually happens. Most are thinking this could be an awful decision and a terrible mistake, especially as it relates to looking at Canada's economy as a whole when not just factoring in the tariffs. And the inflation threat is absolutely real. There are things that can happen and we can see the cost go up dramatically. But the reality is Canada itself is not doing very well. We're seeing less jobs, less people invest, and people have less money overall. Whether or not this is actually a mistake, we'll find out in the coming months, especially as the next announcement comes up in June. Okay, so what should you do? If you're thinking about renewing your mortgage and you're up in the next 12 months, I'd recommend jumping in right now to get a strategy conversation. Now more than ever, there's a conversation to be had about interest rates, but also the strategy to figure out your debt situation. I'm talking to a lot of Canadians who are facing a lot of debt issues right now, and being able to refinance and restructure is opening up cash flow. Now, if you're buying in this type of market right now, I don't think it's for everybody at all, but if you're the type of person that is looking for choice and opportunity and you really don't want to have to go up against and battle a whole bunch of people to purchase a property, it's a prime market for that. Buying in a market personally myself where it was insane and we had a lot of people shopping with us absolutely sucked. And from a perspective of just having choice, it's a really good thing. Plus, the thing is, in this type of economy, it's really volatile and hard to understand specifically where real estate's going to go. But there are no signs as of right now of any major crash, other than the fact that real estate prices themselves will hold pretty steady or soften as you have more competition in the marketplace. The one thing that's interesting, and I mentioned this earlier, is that single family homes keep selling no matter what, especially if they're in a good location and a good piece of real estate. So what do you do next? Send us a DM, follow the information below, and if you'd like to follow more about what's happening in the economy, make sure to follow and listen to the podcast. Thanks for listening. Leave me a thumbs up if you found this valuable.